analyzing and recording transactions. And again, some of this will be kind of a review from what we talked about last week. Basics of financial statements. I know we've talked a little bit about financial statements last week. So business transactions and events are the starting point of financial transactions. Process from transactions to financial statements is as follows. Is that you have to identify each transaction and the event from source documents. And so we'll talk about what those source documents would be. You have to analyze each transaction and event using the accounting equation. Remember, the accounting equation is assets equals liability plus equity, or you could say assets equal liability plus owner's equity. One thing that I may not have made clear last week was particularly when we look at the financial statements and how things have to balance and all of that, remember that the only financial statement that has to balance is going to be that balance sheet. Everything else isn't balanced that way. There may be things that are written side to side maybe, but it doesn't have to balance necessarily, at least not in the same way that the balance statement does. But it all will make sense numerically. You'll see that, okay? Record relevant transactions and events in a journal. Usually that's general journal, but we also use other journals as well. We'll show you that. And then prepare and analyze the trial balance and financial statements. So you prepare the trial balance first, and then you go ahead then and you can prepare your financial statements. So different types of source documents. Some of these we're familiar with even in our personal life. What we have to look at when we're doing bookkeeping are bills from suppliers, sales receipts, checks, purchase orders, payroll records, and bank statements. Those are all different types of source documents. And again, source documents provide objective and reliable evidence about transactions and events and their amounts. So you have to have the source document first, and then you figure out then what took place. So the accounts underlying financial statements. An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. And then the general journal then is the record of all of the accounts that are used, or the general ledger, excuse me. The general ledger is a record of all accounts used by the company. And so we see here kind of an example, different types of asset accounts, and then equals liability plus owner's equity. So we see here, for example, assets accounts include cash, accounts receivable, notes receivable, different things like that. Liabilities would be like accounts payable, short-term notes payable, unearned revenue, we'll talk about that more, accrued liability, and long-term notes payable. And then equity is owner's capital, and then the owner withdrawals, and then revenue and expenses. So those are your different types of accounts. So remember, again, that the basic accounting equation is that assets are equal to liabilities plus equity. The equity section is composed of the owner's capital account and owner's withdrawal account, as well as revenues and expenses. Asset accounts. Assets are resources, remember, that are owned or controlled by the company. And so I know that was something that was tricky, because I was helping a student with her homework, was even if you purchase something on credit, the company still owns it and has control over it. So it would still be considered an asset and have expected future benefits. Most accounting systems included a minimum separate accounts for the assets described again. We talked about that. Cash, accounts receivable, notes receivable, and prepaid accounts. So for an example of a prepaid account that you'll see is prepaid insurance. So even for yourself, sometimes people for like their house insurance, they pay it up for 6 months or a year, or their car. Maybe rather than paying their car insurance every month, they pay it up 6 months. So the part of it that you haven't used, that's prepaid, and so that's an asset. We'll talk about that some more later. Liability accounts. Liabilities are claims by creditors against assets, which means they are obligations to transfer assets or to provide products or services to other entities. Creditors often use a balance sheet to help determine whether to loan money to a company. A loan is less risky if the borrower's liabilities are small in comparison to assets, because this means that they have more resources than claims on resources. Common liability accounts, for example, are accounts payable, notes payable, unearned revenue accounts, and revenue liabilities. And then remember, then again, equity accounts, the owner's claim on the company's assets is equity or owner's equity. Equity is the owner's residual interest in the assets of the business after subtracting liabilities. So we'll take a little bit deeper dive now into the different types of accounts. So these are all different examples of asset accounts. So cash reflects a company's cash balance. It includes money and any funds that a bank accepts for deposit: coins, checks, money orders, and checking account balances. And so usually it's not cash necessarily that's on hand. It could be, not necessarily, okay? But it's the cash that they have available to them, which could include what's in the bank. Accounts receivable are held by the seller and are promises to pay from customers to seller. These transactions are often called credit sales or sales on account or on credit. Accounts receivable are increased by credit sales on account. And so I gave you the example of the dentist and how if he does work and he doesn't receive the cash payment and he doesn't make you have to get care credit, which is like a credit card, then he just holds it. So it would be an accounts receivable for him. Notes receivable is similar to accounts receivable, except it's interest bearing when accounts receivable does not. And then prepaid accounts, I mentioned this earlier, also called prepaid expenses, or assets that represent prepayments of future expenses. Expenses expected to be incurred in one or more future accounting periods, which could be a month or a quarter. When the expenses are incurred later, the amount in prepaid accounts are transferred to expense accounts. Examples are prepaid insurance, prepaid rent, and prepaid services. So you might, for example, with rent, you might pay 6 months of rent at a time. Or you might pay maybe for consulting services and you pay some up front. So that would be an example. But land, buildings, equipment, supplies, all of those would be examples. Okay, liabilities. Remember that liabilities are claims by creditors against assets. Creditors are individuals and organizations that have right to receive payment from a company. This is a listing of common liability accounts we are likely to see in the general ledger. Accounts payable are promises to pay later, which usually come from purchase of merchandise for resale. And I'll give you an example of that. Notes payable is a written promissory note to pay a future amount and often interest bearing. Accrued liabilities are amounts owed but not yet paid. And then unearned revenue is the liability that is settled in the future when a company delivers its products or services. If you subscribe to a magazine, you generally pay a 1-year subscription in advance. As for the publishing company, cash is received, but nothing has been done to earn the revenue. As the magazine is delivered to you, the publishing company recognizes a portion of the money received as revenue. At the end of the year, all of the revenue will be earned and the liability no longer exists. So we're all familiar with that. You purchase a magazine, you pay for it a year in advance, and in each month they send you. As they send you that, it is a note about accounts payable, just an example of that. Like, for example, with our business that we have as a family, my mom, she's the Avon lady. So she sells Avon. So, for example, with them is we're kind of grandfathered in because we've been with them for 18 years. Now it's not this way if you were to sign up today. Is we put in the order. In fact, I did that last night. I put in the order. I did not pay for our customers' merchandise, all $400, almost $500 worth. I didn't pay for it yet. They will send it to me. And so for me, basically that would be an accounts payable. I have to pay them, and I'll pay them once I collect from my customers, put all the money in the bank, I pay them, and whatever's left is our money. But that would be an example of an accounts payable. So they're sending me merchandise on credit. They haven't received payment yet for it. And so they're expecting that I will pay that. And obviously I have to pay that before they will send me any more merchandise. Okay. But some companies will work that way. Some won't anymore, just because, most businesses have credit cards and things like that. So a lot of businesses, they won't work that way anymore with accounts payable. They want to get paid first. Okay, and then again, equity accounts, we've talked about this. The owner's claims on the company's assets are called equity, or stockholders' equity, or the owner's equity. Equity is the owner's residual interest in the assets of a business after deducting liabilities. So let's say that a business, they were to close, well, they'd have to pay their liabilities first. Once the business had done that, then whatever was left out of the assets then could be divvied up then to the owners. Okay. And it could be an individual owner if someone owns a small business themselves, or it could be the shareholders of the company. So for example, I own shares in AT&T in my Roth IRA, which is part of my retirement plan. And let's say AT&T, for some reason, they were to go belly up. They're not going to, but let's say that they did. Well, they would have to pay their liabilities, their creditors first. Whatever was left after that, because then I'm a shareholder, they would then pay to me proportionate to how many shares I own. And they would have to pay to everybody whatever was left out of that. So the equity is impacted by 4 different types of accounts. So owner's capital, owner withdrawals, revenue, and expenses. Owner investments increase both assets and equity. The increase to equity is recorded in the account titled owner's capital. Owner investment are not revenue of the business. So let's say the owner decides he wants to invest $10,000 into his business. Well, he could do that. It would be recorded in an account owner's capital. It increases the amount of equity, also increases the cash, but it would not be considered revenue of the business because it wasn't earned from doing whatever. Let's say it's a cleaning business or it's selling merchandise, whatever. It wasn't earned through that activity. Owners' withdrawals decrease both sides of the equation. The decrease to equity is recorded in the account titled owner's withdrawal or drawing. You could hear it that way too as well. Owner withdrawals are not expenses of the business. All right, so we have this expanded accounting equation. So revenues and owner capital increases equity. Expenses and owner's withdrawals decrease equity. So again, we have our assets over here, all the different ones. And now they're also telling you 2 different types. So you have current assets, long-term investments, plant assets, and then intangibles. We'll talk about some more of that as time goes on. And then you have liabilities. You have current liabilities, long-term liabilities, and then you have the equity. So you have the owner's capital, the owner's withdrawal, revenues, and expenses. Okay. So the ledger and the chart of accounts. And I pointed this out to, again, one of the students because I was working with her on her homework, is in the back of your textbook, I believe it's on a page CA and then CA1, the book gives you a typical chart of accounts. And so that would be something that would be helpful for you when you are working on your assignments and your problems on Connect, to be able to refer to that. So the ledger is a collection of all accounts and their balances for an accounting system. The company's size and diversity of operations affects the number of accounts needed. And then again, the chart of accounts is a list of all of the accounts and includes an identifying number for each account. So the accounts, they can be numbered, and especially when you're working on the computer, that's important that the accounts are numbered. So let's say it's just a small mom and pop, maybe, I don't know, maybe it's the gas station. It's the, for example, a local Arco gas station. I know it's a woman that owns the one here in Atwater. She may not have that many accounts because it's something, you know, fairly small what she's doing, especially if she just has that one store. Now, let's say it's something like Merced College. Merced College might have, I don't know, hundreds of different accounts because they have to keep track of money, different funds for different things, different programs. There's a lot of things going on if you were to look at that. And then let's see, so the chart, we talk about chart accounts. Notice that all the assets begin with account number 1, all the liabilities account number 2, equities a 3, revenues a 4, and expenses a 6. And you see that there in the illustration. All right, and I alluded to this the other day, but we'll kind of, this is when it's going to become really important, is debits and credits. So a T account represents a ledger account and is used to show the effects of one or more transactions. And so you have the debit side and you have the credit side. The debit would be on the left-hand side of a T account. The credit would be on the right-hand side of the T account. Accountants, they often use T accounts to represent the general ledger account. The account title is entered at the top of the T account. The left side of the T account is always called the debit side, the left side. The right side is always called the credit side. This terminology comes from a time when the first double entry system was developed. We still use the terms as a convention. The terms debit and credit by themselves do not mean increase or decrease. And I think that's the part I think that gets confusing, is understanding that debit and credit don't necessarily in and of themselves mean increase and decrease, okay? Because it's easy to get stuck on that, and then you're going to have a lot of problems, okay, understanding exactly what's going on. This is probably one of the trickiest parts, and once you understand this, then you'll be good, okay? So whether a debit or a credit is an increase or decrease depends upon the account, and again, the type of account it is and what's happening. The difference between total debits and total credits for the account is the account's balance. When the sum of the debits exceed the sum of the credits in a particular account, the account has a debit balance. Okay, so we see double entry accounting, and again, we have the assets, liabilities, and equity. This is a really good slide. So you might want to, if you have a pad of paper, you might want to take a note of this. So accounts that are assets on the left-hand side with a debit increases. So for example, cash would be one. We receive cash as a business, we would have to debit cash, and cash, the amount of cash that we have would increase. So we know that it has a debit side is the normal side. And then on the left-hand side is a credit, and a credit decrease, or right-hand side, excuse me, is credit, and a credit decreases. So if we pay out cash, we have to credit cash, okay? We'll see this in a minute. Now, liabilities on the left-hand side is a debit, and that decreases liabilities. So let's say you had accounts payable, you paid the bill. So if you paid the bill, you would have to debit, which would actually reduce the liabilities. Now, if you were increasing, like let's say you are purchasing something on credit or whatever, you're increasing, so then you would have to credit that, which would increase it. So debit decreases, credit increases. And in equity, then same thing. because again, it's on the other side of that equal sign. So debit decreases equity. So if you, let's say, for example, you're paying out owner's drawing or with withdrawal, that would be a debit decrease. And then if we want to increase equity, we would credit it to increase it. Again, thinking about this, equity increases from revenue and owner's investment, owner's capital, and it decreases from expenses and withdrawals. We see this by expanding the accounting equation to include debits and credits in a double entry form. Increases credits to owner's capital and revenues increase equity. Increases debits to withdrawals and expenses decrease equity. The normal balance for each account, asset, liability, owner's capital, owner's withdrawals, revenue, or expense, is the side of the account where the increases are recorded. So again, this is an example then of a typical T account with some transactions recorded. So we determined the balance in the accounts in the last chapter, but in this chapter, we will look at a more comprehensive way to determine an account balance. The cash account is an asset, so increases or receipts are shown on the debit or left side, and decreases or payment are shown on the credit or right side. To determine if an account is a debit or credit balance, we total the right and left sides and place the balance on the larger side. In this example, our increases in cash amount to $36,100 and the decreases total $31,300. So the cash account has a debit balance or a positive balance of $4,800. So journalizing and posting transactions. So the first thing that we have to do is to identify the transactions and the source documents. So you may look at your bank statement, you may look at your purchase order, sales receipt, client billing, or service contract. That is the first thing. The next thing you would do is you would analyze the transactions using the accounting equation that we've talked about. Remember, assets equal liability plus equity. And then you would record the transactions in the journal entry. And so we see here, for example, you always usually have the date first, and then you list the debit first, and then the credit. The credit is always indented. And so you see that. So for example, on December 1st, C. Taylor paid in capital. So we received cash, $30,000, that increases capital. And then C. Taylor capital, we have to credit that, but because it's on the other side of the equation, a credit is actually what increases it. And then you post the entry then into either into the general ledger. This is an example of the general journal. So here is an example of the proper recording of a general journal transaction. We have seen a similar transaction before. In this case, the owner of the businesses contributes $30,000 to start the business. Let's see how we get the various pieces. The transaction occurred on December the 1st of 2019. The date is important in recording general journal transactions and is recorded on the left side of the journal. And so we see that here, number A. So we always put the date first. Next, we identify the accounts affected by the transaction. The cash account is an asset that has increased. We show increases to asset accounts with a debit to that account. So we see then that we're going to list that first because it's a debit. Okay. Now, the C. Taylor capital account also increased, and we show increases in equity accounts with a credit. So then we see that the credit then is listed on the second line and it is indented. Debits are always listed first in the journal, followed by credits that are slightly indented below the debits. And so this is if you were going to write it out like on a ledger, you would do it this way. And then even on the computer, if you were, let's say, you're going to go into QuickBooks and you're going to print out a copy of the general journal, it would look very similar to this. Okay, even doing it on the computer. Now, the dollar amount is placed in the appropriate debit or credit column. In this case, the cash account is debited $30,000, so it's placed in the debit column. Finally, we prepare a brief, and then they put the credit balance where it goes. Now, finally, we prepare a brief description of the transaction so that other people who view our work will understand the nature of the transaction. This explanation is indented about as far as accredited account titles to avoid confusing it with the accounts, and it is italicized. Okay. So you would do that. The other thing to note here is that when you're doing your transactions is that both the debit and the credit have to balance. Now, what is possible is you might have one debit and then you might have multiple credits. So then all of those credits would have to equal up then to that debit balance. I don't know if we'll see one like that or not, but we probably will later. Okay. So the account balance column. This is kind of like, I don't know if any of you use a checkbook. Probably not, because most people just use their card or pay online. But if you look at a checkbook register, so with a checking account, you get like a little book like this. And I'll kind of show you, it's kind of a similar concept. Here, so you have, it's kind of similar to this. This is a checkbook register, but it's kind of similar, right? So you have the check number, but you'd have the date, transaction, and then you notice over here, there's a balance where you'd write the balance. It's very similar to that. What the general journal is very similar then to what you'd have in a checkbook, okay? So T accounts are useful illustrations, but balance column ledger accounts are used in practice. So we don't journalize on T accounts, and when we're actually doing the books of a business, but they help you in order to learn, okay? And so on the homework, I know there are some of the questions that you'll have to put the things in the T accounts, but in practice you won't actually be doing that. In fact, way back when I was in school and I was learning how to do accounting, we actually used to have to do all this by hand with pencil and paper. So you see here then that the balance column account format is similar to a T account, having columns for debit and credit. The difference includes the transaction date and explanation columns. It also has a column with the balance for the account after each entry is recorded. The cash account is debited on December 1st for the $30,000 owner investment, yielding a $30,000 debit balance. The account is credited on December the 2nd for $2,500, utilizing a $27,500 debit balance. On December 3rd, it is credited again, this time for $26,000, and its debit balance is reduced to $1,500. The cash account is debited by $4,200 on December 10th, so its debit balance increases to $5,700 and so on. So we see here how that's done. So the general ledger then is just taking the information from the general journal and then summarizing it then for each account. Posting journal entries. Posting is a process of transferring the information from the general journal to the general ledger. There are 4 steps to the posting process. Identify debit accounts in ledger, enter date, journal page, amount, and balance. Enter the debit account number from the ledger to the PR account in the journal. Identify the credit account in ledger, enter date, journal page, account, and amount and balance. Enter the credit account number from the ledger in the PR column of the journal. So we see that here. And so this is what you do after you write them in the general journal, then you take it to the general ledger. Okay. And now, of course, a lot of this you're doing, on the computer through QuickBooks, but we need to understand the process and what exactly that's doing. Now, processing transactions. Double entry accounting is useful in analyzing and processing transactions. Analysis of each transaction follows the following 4 steps. So step 1 is to identify the transaction in any source document. Step 2 is to analyze the transaction. using the accounting equation. Step 3 is to record the transaction in journal entry form, applying double entry accounting, and then post the entry. To simplify, we use T accounts to represent ledger accounts. Let's look at some examples. Okay, so the first one here we'll look at is, we'll identify it's a receive investment by owner. So Fast Forward receives $30,000 cash from Chaz Taylor as the owner contribution. So we analyze and we know then that our assets are increasing by 30,000, and we know that our equity is increasing by 30,000. So we record cash, the account number, 30,000, debit because it's increasing, and then we record then C Taylor Capital. We have to credit that for 30,000. And again, you do that because you're crossing the other side of the equal sign, and then you post it then to the general ledger. Okay, the next one, purchase supplies for cash. So Fast Forward pays $2,500 cash for supplies. So we subtract $2,500 cash, and then we add supplies. So then supplies, we have to debit supplies $2,500 because that's an asset and it's increasing, so we debit. Cash, we're going to credit $2,500 because cash is decreasing because we paid out cash, and then you would post it then accordingly. Purchase equipment for cash. Fast Forward pays $26,000 cash for equipment. So we know then that we're going to decrease cash decrease cash 26,000, and then we're going to have to increase equipment by 26,000. So we record equipment, debit 26,000 because we're receiving equipment that's increasing. Cash, we're going to credit 26,000 because we're paying cash, and then we post it. Purchase supplies on credit from a supplier. So Fast Forward purchases $7,100 of supplies on credit from a supplier. So our supplies are going to go up, so we're going to increase supplies. And then our liabilities are going to increase because we've not paid cash for these supplies. We've put them on account. So we have a liability to the company that we purchased them from. So we have supplies, we're going to debit that $7,100 because supplies as an asset is increasing. And then we're going to have to credit our accounts payable by $7,100 because the amount that we owe is increasing. Provided services for cash. So Fast Forward provides consulting services and immediately collects $4,200 in cash. So our cash is going to increase $4,200, and then our equity in the form of consulting revenue is going to increase by $4,200. So we see here cash, we debit cash $4,200. Consulting revenue, we will credit for $4,200 because we are increasing the amount of revenue that we've received. Payment of expense in cash. Fast Forward pays $1,000 for December rent. So our cash is going to decrease by $1,000 because we're paying that out. And then our equity is going to decrease as well because we have a rent expense of $1,000. So we see here that we have to debit rent expense $1,000 because that increases the expense on that account. And then cash, we're going to credit $1,000 because we need to decrease our cash. Payment of expense in cash. Fast Forward pays $700 for employee salary. So again, the cash would decrease $700 because we're paying out cash, and then the salaries expense will increase by $700 because we're paying it for salary expense. So salary expense, we will debit $700, and then we will credit cash for $700. And providing consulting and rental services on credit. Fast Forward provides consulting services of $1,600 and rents its test facilities for $300. The customer is billed $1,900 for these services. So we see here that our accounts receivable asset increases by $1,900 because we're expecting that we will be paid. So in order to increase an asset, we have to debit it. So accounts receivable, $900. And then consulting revenue and rental revenue, each of those is increasing. So because they're increasing, we will credit them. So $1,600 and $300. Notice too that we separated out our revenue types. So some of it is being derived from consulting. Some of it is being derived from the rental of our facility. And then cash on a receipt of cash on account. Now, Fast Forward receives $1,900 cash from the client that we billed in transaction 8. So cash increases by $1,900, and then our accounts receivable decreases by $1,900 because now we've paid that. Now that they've paid, we're not expecting to receive that money. We've already received it. Partial payment of accounts payable. Fast Forward pays Caltech Supply $900 towards the transaction that we did in 4. So we have accounts payable, $900. We're going to debit accounts payable because we now no longer owe as much. So that decreases what we owe. And then we have to credit cash $900 because we're paying cash out. And then withdrawal of cash by owner. So Chaz Taylor withdraws $200 of cash from Fast Forward for personal use. So we have to subtract cash because cash is going down. Also have to subtract from C Taylor withdrawals because now he doesn't have as much equity. So C Taylor withdrawals, $200 debit, and then credit cash. Okay, so receipt of cash for future services. Fast Forward receives $3,000 cash in advance of providing consulting services to a customer. So we receive cash in the amount of $3,000. And then we also have a liability, which is unearned consulting revenue of $3,000. Now note that accepting the $3,000 in cash obligates Fast Forward to perform future services and is a liability. No revenue is earned until those services are provided. So we see that cash, we are going to increase that by $300, and then unearned consulting revenue, we're going to credit that by $300 because we owe that to our customer. They've paid us the cash, so we have to provide the service to them.
So after every service, do you have to go in and reduce that amount on the sheet?
On the unearned, yes. In this case, you would, because being that they've prepaid for their service, then yeah, you would, after they do it, then you would end up, so what you do then is you would debit the unearned consulting revenue and then credit regular revenue at that point, in order to increase the regular revenue, decrease the liability. Because the liability is the unearned consulting revenue, and then the equity then would be the actual regular normal revenue that we would ordinarily use. Does that help?
Yes, thank you.
Okay, thank you for asking that. Yeah, so that's the thing. And so again, the example we talked about, I know before we talked about the magazine, that's what they would do. Let's say you paid, I don't know, $20 for this magazine for a year, and in each, and maybe they only send it to you maybe twice a year, so every 6 months. So if they sent it the first time, they earned $10 of that 20. They send you your last issue, they earn that other 10. and then they would go in and do it. What would happen, let's say this company, fast forward, let's say they received that cash and then never did the service. Let's say they closed down after that. They would be responsible and didn't provide the service. They would be responsible then for providing that cash money to the customer they took it from, because they didn't provide the service that was tied to it. Pay cash for future insurance coverage. So Fast Forward pays $2,400 cash. That's the insurance premium for a 24-month insurance policy. Coverage begins on December the 1st. So cash decreased by $2,400, and then prepaid insurance increased by $2,400 because we paid cash for it, but then we have prepaid insurance that's an asset of $2,400. Now, this changes the composition of assets from cash to prepaid insurance, and the expenses occurred as the insurance coverage expires. So each month, or I don't know, every 6 months or every year, you could go in here and figure out then how much of it you used, and then you would have to go back in and record that. But for this part here, just paying the cash and getting the prepaid insurance, you would debit prepaid insurance $2,400 because we want to increase that asset. Cash, we would credit $2,400 because we are decreasing that asset. And then purchasing supplies for cash. Fast Forward pays $120 cash for supplies. So again, our cash is going to decrease $120. Our supplies is going to increase $120. So supplies, debit $120, and in cash, we're going to credit $120. And then payment of an expense in cash. Fast Forward pays $305 cash for December utility expense. So cash is going to decrease $305, and then the utilities expense is going to decrease $305. So utilities expense, you're going to debit $305, and then you'll credit cash. And then same thing here. Fast Forward pays $700 cash to employee salary for work performed in the latter part of December. So we're going to reduce cash, reduce the salaries expense. So salaries expense, we're going to debit $700, and then we'll credit cash. So then we see here, this is a summary of all of the transactions. So Exhibit 2.13 shows the ledger accounts in T-account form for Fast Forward after all 16 transactions are recorded and posted and the balances are computed. The accounts are grouped into 3 columns corresponding to the accounting equation: assets, liabilities, and equity. The totals of the 3 accounts obey the accounting equation. The capital, withdrawals, revenue, and expense accounts reflect transactions that change equity. These 4 accounts make up the statement of owner's equity. Preparing the trial balance has 3 steps. So the first thing that we have to do is we have to list each account title and its amount from the ledger in the trial balance. If an account has a 0 balance, list it with a 0 in a normal balance column, or we can omit it entirely. Compute the total of debit balances and the total of credit balances. And then we can prove total debit balances equal the total credit balances. Okay, so then we know then that the total of the debit balances equal the total of the credit balances for the trial balance. However, equality of these 2 totals does not guarantee that no errors are made. So we see here, this is an example of Fast Forward's trial balance from what we discussed a few minutes ago. So the trial balance lists all ledger accounts and their balances at a point in time. If the books are in balance, the total debits and credits are equal. And so we see that, and then that's designated by the double underline under that. So if you look at let me move my mouse. If you look at the totals here, you'll see that. Now, searching for errors. If the trial balance does not balance, the errors must be found and corrected, okay? This is why it's important when you're doing this to take your time, because it can be very tricky to go back and find out where you went wrong. So the first thing that you'll do is you'll verify that the trial balance columns are correctly added, because it's easy to transpose a number or to make a mistake there. Verify that account balances are accurately entered from the ledger. See whether a debit or credit balance is mistakenly listed in the trial balance as a credit or debit. So you might have gotten those two reversed. So watch for that. Make sure you didn't get those reversed. Recompute each account balance in the ledger. Verify that each journal entry is properly posted, and then verify that the original journal entry has equal debits and credits. Preparing financial statements from business transactions. So as we have seen in the last chapter, after the trial balance has been prepared, we begin preparing the financial statements. We always begin with the income statement, because net income from the income statement appears on the statement of owner's equity. After the income statement, we prepare the statement of owner's equity, because the ending balance in owner's equity appears on the balance sheet. Next, we prepare the balance sheet, and then finally, we prepare the statement of cash flows. These are the four financial statements and their purposes. The income statement reports revenue less expenses along with the resulting net income or loss by a business over a period of time. Statement of owner's equity reports changes in equity over the reporting period from net income or loss and from the owner's withdrawals over a period of time. Balance sheet reports the financial position, the types and amounts of assets, liabilities, and equity at a point in time. The statement of cash flows lists the cash flows and cash outflows for the period. And then for simplicity, we're not going to look at the statement of cash flows for fast forward in this chapter. What we would do return to this statement in the next chapter. This is the example of the income statement. And so we see that information about revenues and expenses is conveniently taken from the trial balance. Net income of $3,395 is reported at the bottom of the statement. Note that owners' investments and withdrawals are not part of income. So that's really important to realize. We have to have that net income number, because that's going to figure into the next thing that we're going to look at, which is the statement of owner's equity. Fast forwards, statement of owner's equity is the second report on this slide. So again, at the top, we see the income statement, and then at the bottom, we see the statement of owner's equity. It shows the beginning balance of 0 plus the investment by owner of $30,000. And then we see $3,395 of net income, because that's under plus for owner's equity. So then we have the total, subtotal there, less the withdrawals, plus the withdrawals, less the withdrawals by the owner of 200. So then we see that C. Taylor capital, and it ended for December 31 of 19, was $33,195. But you see here that we have to take the net income number from the income statement, and that becomes one of the items that we have to put in the statement of owner's equity. Then we see the statement of owner's equity and then we see the balance sheet. So fast forwards, balance sheet is at the bottom report on this slide. This statement reflects the financial condition at the close of business on December 31st. The left side of the balance sheet lists its assets, which are cash, supplies, prepaid insurance, and equipment. The upper right-hand side of the balance sheet shows that it owes $6,200 to creditors and $3,000 in services to customers who paid in advance. The equity section shows an ending capital balance of $33,195 from the statement of owner's equity. Note the link between the ending balance of the statement of owner's equity and the capital balance. And so we see that we take the number here and in here. Then we see if we add this plus all the liabilities, we have that number. And then we see here then that you have the assets. So we know then that the total for the assets has to equal the total of the liabilities and the equity. The balance sheet has to balance on both sides, but you notice that the income statement does not. And you notice that the statement of owner's equity does not, at least not in that way. Now, some presentation issues. We see that dollar signs are not used in journals and ledgers. We see that dollar signs appear in financial statements and other reports such as trial balances. Put dollar signs beside only the first and last numbers in a column. When amounts are shown in a journal, general ledger, or trial balance, commas are optional to indicate thousands, millions, and so forth. Commas are always used in financial statements, and companies commonly round amounts in reports to the nearest dollar or even to a higher level. We're going to look at accounting ratio and how we can use that in order to figure out how to analyze the condition of our business. So we learn now about what's called the debt ratio, which is the total liabilities divided by the total assets. That evaluates the level of debt risk. So note that a higher ratio indicates that there is a greater possibility that a company will not be able to pay its debts in the future. And so we see here, borrowing money is risky business. The debt to assets ratio helps evaluate the level of debt risk. We determine a company's ability to pay its assets liabilities using the debt ratio. The debt ratio is equal to total liabilities divided by total assets. A higher ratio indicates that there is a greater probability a company will not be able to pay its debts in the future. So we'll take a look here at an example. Costco's debt ratio ranges from a low 0.63 to a high of 0.70. Its ratio is exceeded the Walmart's in each of the last 3 years, suggesting a higher than average risk from financial leverage. If Costco is making more money with this debt than it is paying the lenders, then it is successfully borrowing money to make more money. A company use of debt can quickly turn unprofitable if its return from that money drops below the rate it is paying lenders. We can see here that, for example, the red is Costco, and in the second line there is Walmart. We see that Walmart, that they don't use as much debt as what Costco does. Costco does a lot more things on debt in order, and they're using that in order to build more stores and do more things that what they think are going to help them.